Good morning, Tony, as you would like to be known. Tell us a bit about NEUBERGER BERMAN and what you do.
Sure. NEUBERGER BERMAN is an employee-owned asset management firm. We manage about 500 billion of assets all around the world. And of that 500 billion of assets, about 120 billion is in private markets.
That's quite a lot of AUM, so you're one of the big players.
Yeah, even, I don't know, wherever you grew up, that's a lot of zeros. So.
Yes, indeed. So you have a lot of authority to talk about things. And I wanted to ask you about the context of partnering and investing with PE firms. How has things changed between 5 years ago and now?
So I think GPs face three really big challenges. First of all, their investor base has become more diverse and a lot more demanding.
Yes.
That's one. Two, the regulatory environment is increasingly complex. But I think the biggest challenge, the third, and the elephant in the room, is it's going to be much more difficult to continue to generate the kind of returns that investors expect. And I think this is because the free lunch is over. You no longer can rely on interest rates coming down and valuations continuing to come up as a way to generate returns. So you have to add value to the companies that you buy. And we do about 500 to 600, or we review 500 to 600 co-investments a year.
Yeah.
And when we look at the projected returns and where they come from, now the returns are coming mostly from strategic and operating plans to accelerate revenue growth, to increase margins, and then strategic M&A to add value to those businesses. The GPs understand the environment, and in fact, when we look at the last 30 transactions that we've done, the GPs are actually projecting that they're going to exit their investments at 1.3x multiple less than they went in at. So that's why it's so important that they add value to these companies.
Okay. And after, with everything you've said, would you say the co-investment environment is strong, or you see it accelerating, or are people struggling? I mean, what's the mood?
So it's a great question, and you have to look at different parts of the co-investing market. M&A activity in general is down. We know that. Financing is more difficult. The bid-ask among buyers and sellers is wider, so less new deals are getting done. But at the same time, GPs are focused on bringing cash back to their investors. So our co-investment deal flow is actually up. The traditional deal flow of new deals is down, but we're looking at a lot more transactions where we're coming into existing portfolio companies and buying a minority interest as a way for them to get capital in their company or as a way for them to get liquidity back to their investors. So that has been a huge increase from where it was in the last few years.
And with consolidation going on, and I think you will mention on your panel that LPs are trying to reduce the number of relationships they have. What does this mean for emerging managers? What do they have to do to be successful?
Yeah. So it is true that many investors are trying to reduce the number of core relationships they have, and they want real partnerships with those core relationships. So in general, they're reducing those. On the other hand, most investors are still interested in the differentiated returns that you can get from emerging managers. Emerging managers tend to focus on niches in the marketplace that are less efficient. They tend to focus on smaller companies because of the size of the companies that they're looking at to invest in. So that brings something to the portfolio that your core relationships can't bring. And at the same time, they're hoping that over time, some of these emerging managers will graduate and become core relationships for them. So it's a very important part of the investing that many PE investors are doing today.
Tony, thank you for those insights. That was very useful. And I hope to see you again next year in Paris.
Thank you.